Okay, so now let's come back. We're gonna look at some properties of duration. These properties actually correspond to the previous observation that we have on the graph. The first property is that the duration of the zero coupon bond equals its time to maturity. All right, so this we already talked about it because there are no coupon payments for a zero coupon bond. Therefore, the duration will be equal to the time to maturity, or maturity simply. Second rule is that holding maturity constant, a bond's duration is higher when the coupon rate is lower, right? So this is coming from our observation 5, and also our previous numerical example, right? Basically, when the coupon rate is lower, bond prices are more sensitive to yield, the change in the yields. And again, the idea is that a higher fraction of the total value of the bond is tied up in early coupon payments whose values are relatively insensitive to yield, right? So because the later coupon payments, they're discounted more heavily, right? That's kind of idea. Now let's look at another graph here. Another graph here shows you the relation between duration and maturity, right? With different kind of bonds, right? So this is the zero coupon bonds. So in that case, duration will be just equal to the maturity. Now, that's why it's a 45-degree line, right? Now we have another 3 bonds. This is a 15% coupon, yield to maturity 15%. This is a 3% coupon, 3% coupon rate, yield to maturity 15%, right? So this already shows our our second property, right? So if the coupon rate is lower, the bond prices are more sensitive, hence the duration is higher, right? So this is already reflected in this graph. Now, if we compare the blue one to the gray one, right? If the coupon rate is the same, if you have a lower yield to maturity, the duration is also higher. So this is our observation. This is our previous observation on yield to maturity. Right, so the sensitivity is inversely related to the yield to maturity, right? So yield maturity is lower, sensitivity is higher, right? So this already confirms the observation. And holding the coupon rate constant, the bond duration generally increases with its time to maturity, right? This is observation 3, right? You can find it in the previous observation. Also, you can see from the graph, right? When the maturity increases, duration increases, right? But remember, the rate of increase, right? The speed of increase is actually slower and slower. All right, so that's also our previous observation, right? Duration increases with maturity, but with a decreasing speed, right? So and that is because the price yield curve is convex, right? So this all goes back to the previous observation. And duration does not need to increase with time to maturity, right? For example, if you look at this bond here, right? When the maturity is much longer and longer, actually the duration actually slightly decreases, right? So for certain deep discount bonds, the duration actually fall with increases in maturity, right? So this is the extreme cases, right? But in general, duration increases with maturity. And this holds for bonds that sell at par and also at a premium to par, right? So in these kind of cases, premium increases with maturity. Now, rule 4 and 5, right? Holding other factors constant, the duration of a coupon bond is higher when the yield to maturity is lower, right? So this I already mentioned. And this is the intuition for it, right? So if the yield to maturity is lower, the more distant payments have relatively greater present values and account for a greater share. Right? Remember, the yields are used to discount more distant payments, right? And then if you have a lower yields, the more distant payments have a much bigger discount factor, right? So then in a weighted average calculation of duration, the distant payments receive greater weights, right? Let's go back to the formula here. How do we calculate the weight? The weight here, if you have more distant payments, the more distant payment, the weight is much higher, right? So if you have a lower yield to maturity, this part becomes bigger, and that's why the weight becomes bigger, right? Or for all the payments, but for this for more distant payments, that weight becomes even bigger. So, and then in that case, when we calculate the duration measure, the distant payments receive greater weights, right? So then this will give you a higher duration measure, right? And the reason is that if you have lower yield to maturity, the weight is high, right? And if we have a level perpetuity means that this we talk about in the first class when we talk about perpetuity. Right? Perpetuity essentially means that this kind of bond, this kind of asset pays fixed cash forever. Right? In that special case, the duration is 1 plus y divided by y. So this is the special case. Right? Now as we finish talk about the duration, we're going to move on to talk about another property of bonds, which is called convexity. Right? So why do we need convexity? So we need convexity because in the first step, we talk about duration, right? So duration is you can think about that is the first order measurement of the sensitivity of the bond prices to yield, right? It's a simple slope, right? And if we use duration, and which is a simple slope of the curve, we cannot actually capture the curvature, right? Because remember, price yield curve, it by itself, it's not a straight line. It is a curve, right? We can use a simple slope to measure the slope of the curve, but we cannot capture the curvature of the curve, right? Because you can have two price yield curve with the same slope, but with very different curvature, right? So you can see this is the actual price yield curve, right? This captures the actual price change. And this is the duration approximation, which is a dashed line, right? So the slope of this dashed line is the duration approximation. Now you can see duration approximation cannot capture the slope here, right? Oh, sorry, cannot capture the curvature here, right? And actually the curvature is important here, right? You can see the duration approximation actually underestimates the increase in the bond prices when the yield falls, right? You can see when the yield to maturity goes down, it underestimates the price increase, right? Price increase is much bigger than the duration approximation. When the yield to maturity actually increases, the duration approximation overestimates the price drop, right? So this is the approximation. It overestimates the price drop, right? So that's why it is important then to capture the curvature of the price yield curve, right? And how do we capture that kind of curvature? We should use the convexity measure. So convexity, it is the second order approximation to the price yield curve. That's why I can capture the curvature, right? Now, what that means is that if we expand the change in the prices, duration is the first order approximation. Convexity is the second order. It is the second order because it is the you can see. I mean that is a kind of sensitivity to the changing the yield to the power of 2, right? To the square of the yield to maturity change, right? And in that case, the kind of interpretation of a convexity measure is that it is the rate of change of the slope of the price yield curve, right? It is the speed of change in the duration, right? Because duration is the slope of the price yield curve. Right? That is the idea. So now you can see why do investors like convexity. We can compare two bonds, bond A and bond B. And bond A is more convex than bond B, right? Now you can see bond A has this nice feature. So what is the nice feature? The nice feature is that when the yield to maturity, when the yield goes up, the bond A's prices do not drop that much as compared to B, right? When the yield goes down, which is a favorable environment, bond A's price increases much more than bond B. Right? So what that essentially means is that bond A is more convex, which means it has more upside potential, right? Because the price goes up more. It also has a lower downside risk, right? So that's why convexity is a nice feature, right? That is, bond A enjoys this greater price increases and smaller price decreases when the interest rate fluctuates by larger amounts. Right? So that's why when the interest rate is volatile, that is the attractive asymmetry, right? That will increases the expected return on the bond. Okay, that is the second part of the class, which we talk about how do we measure interest rate risk, right? Now we're gonna look at yield curve, right? We're gonna look at a yield curve. So what is yield curve? Yield curve, it's a very important indicator for macroeconomic well-being. And essentially it shows the relationship between yield to maturity and the time to maturity. So essentially, it tells you what is the yield to maturity for bonds of 10-year maturity versus for a bond of 30-year maturity. It gives you different yield to maturity, right? And basically, we can use the yield curve to infer the future short-term rates, right? So that is the idea. And we're gonna do this inference in a bit. So these are the four graphs, gives you the Cherry yield curves at 4 different points in time, right? The first one is the January 2006 yield curve. It's a flat yield curve. So which means when the maturity goes up, the kind of yield doesn't seem to change, right? The second one is the rising yield curve, which was in December 2012, right? The third one is the September 11th, 2000 yield curve, right? So this is the terrorist effect. So this is when the terrorist attack happened, right? And you can see this is the upward sloping yield curve. This is the downward sloping yield curve, right? And in October 4th, 1989, this is a hump-shaped yield curve. Right? Now later we're gonna see what does that mean, right? Especially what does the upward sloping yield curve mean? What does the downward sloping yield curve mean? Right? So we're gonna revisit this in a bit. Now we're gonna look at first, right? The first kind of yield curve is yield curve under certainty, right? So this means that there is no interest rate risk there. There's interest rate, so interest rate is we know the future interest rate for sure, right? So there's no interest rate uncertainty there. Now we're gonna see how do we infer the future interest rate from the yield curve, right? So suppose we want to invest for 2 years, and then there are 2 ways to do it. We can buy and hold the 2-year zero coupon bonds, or we can roll over a series of 1-year bonds, right? So I mean, we say a series of 1-year bonds, but essentially they are just two 1-year bonds, right? Because we are going to invest for 2 years anyway, right? So in a competitive market, equilibrium requires that both strategies provide the same return, right? Because if they don't have same return, there could be arbitrage opportunity, right? And because investors are competing for arbitrage opportunity, so if the competition dominates, then there should be no arbitrage opportunity on the equilibrium. So finally, both strategies they should provide the same return. Right? So first of all, we're gonna conclude that the upward sloping yield curve is the evidence that the short-term rates are going to be higher next year than they are now. This is the evidence we're gonna explain to you. Now let's look at a diagram here, right? So you have 2 strategies here. The first strategy illustrated in this graph, right? You can buy a 2-year zero, right, with the yield equaling 6%, right? So then you buy this $890, and then at the end of the 2 year, you get 1,000, right? That's why the rate of return you get is 6%. And this 6% is the two-year yield, right? As of year 0. Now, there could be another alternative strategy. The alternative strategy is that you first buy the 1 year 0, right? And then roll this 1 year 0 for another year, right? Of course, you need to be aware that the yields in the first 1 year and in the second 1 year, they're different, right? Because I mean, obviously the time has changed, right? So therefore interest rate has changed, right? But now, how do we calculate the future value of this 890, right? If we use this rollover strategy, at the end of the first year, we get 890 times 1.005, right? So because the first year interest rate is 5%, right? Therefore, at the end of first year, we have 934.5, right? Now, we don't know the interest rate for the second period, right? So after we apply, we suppose that's R2, right? So that means at the end of the second year, the future value of this 890 is going to be 934.5 times 1 plus R2, right? And then, but previously we talked about competitive market, right? So competitive market ensures that these two strategies should provide the same rate of return, right? So then 1,000 should be equaling this one here, right? So we can solve for R2. So buy and hold 2 year 0 should be equal to roll over 1 year bonds, right? So we can solve this equation and we get 7.01%. Right? So this is the second year's yield, or we also call it, the other name for it is called short rate, right? Short rate, the second year. Now you can see why, if there's an upward sloping yield curve, then the future interest rate is going to increase. Why? Because let me just look at, right? So let me see it this way. Let's see this one, right? So this is a little bit upward sloping here. So the 2 year, when the maturity is 2 years, right? This is the 2 year yield. In our case, it's 6%, right? This is the 1 year. This is the yield of 1 year 0. It is how much? It is 5%, right? So then our calculation already implies that the second year, the next year's interest rate, which is the second year yield, is going to be 7%. Now 7% is much greater than 5%. So then this already implies that if you have an upward sloping yield curve, that the interest rate is going to be higher in the future, in the next year. Right? Okay, now we're going to introduce some concepts, right? Spot rate and short rate. So spot rate, it is the yield maturity on 0 coupon bonds, and it is the rate that prevails today for the given maturity. Right? For example, today, the yield to maturity of 2 years 0 is, let's say, 6%. Right? The spot rate for 30-year bond is like 10%. Right? So for example. So short rate is the rate for given maturity at a different point in time. Right? So short rate, so this is important. Short rate for a 1 year 0, it could be very different at a different point in time, right? Short rate for this year, so short rate as of now for 1 year 0 could be 5%. Short rate for 1 year 0 next year could be 6%. Short rate for 1 year 0 2 years later, it could be 8%. It could be very different. So you can think about that. You can think about the short rate as the realized future interest rate, right? For given maturity in the future, right? For example, the future interest rates for 1 year 0 is going to be 5%, right? And then for example, 1 year 0, the future interest rate for 1 year zero. After 5 years, it's going to be 8%. This 8% is going to be the short rate, right? So it's the realized interest rate in the future, right? Now, from our calculation, we know that the spot rate is the geometric average of its component short rates. Right? So in our example, this 5% is the 1 year zero. It is the interest rate of the 1 year zero. R2, it is the short rate of the 1 year zero next year. Right? So that's why 5% R2, which is the 7%, they are all short rates, right? This 6%, this is the spot rate, right? Because this is the rate, this is the yield for given maturity, 2 year zero, right? So now you can see this equation tells us that the spot rate, which is here, it is the geometric average of these two, right? What is these two? These are the two short rates for 1 year zero, right? So for example, the 2 year spot rate is a geometric average of today's short rate and next year's short rate. Yeah, so this is already coming from our numerical example. Right, so this is the competitive condition, right? Now, again, we can further kind of strengthen our conclusion about the slope of the yield curve, right? When the next year's short rate R2 is greater than R1, right? The yield curve the slope of yield curve will be higher, right? And then this might indicate that rates are expected to rise, right? Again, we say it's may, right? So later we're gonna explain why this is not necessarily true, right? It could be true, it could be not, right? Depends on how steep the yield curve is, right? Now, when the next year's short rate is lower than today's short rate, the yield curve will slope down, right? The slope will be negative, right? This might indicate that rates are expected to fall, right? So this is the idea. Now, another idea here is called holding period return, right? Because we impose this competitive condition, which is the strategy, no matter how you invest, right? They should offer competitive return, right? No matter you buy a 3 year 3 year zero or you buy 3 1 year zero, they should offer the same return. That's the idea. You might think that the bonds that are sold at a high yield to maturity will offer higher 1 year return, but that's not the case, right? So because in a world of certainty, because we know all the future rates, all bonds must offer identical returns, right? So that means 10-year maturity, 10-year bonds should offer the same rate of return than a 1 year bond, right? So that is the idea. So of course, when we talk about the same kind of return, we are talking about the same annualized return, right? So what that means is that a 30-year bond should offer the same 1 year return as a 10-year bond. That is the idea, because in the world of certainty, all bonds should offer identical return, because otherwise investors will flock to the high return security and bidding the prices, then reducing their return, right? This is almost like a no arbitrage condition. Now, suppose the 1 year bond, they could be bought today for how much, right? So this is $1,000. This is the par value, right? Divided by 1 plus the discount rate 5%, right? So this is the price, right? And then this 1 year bond will mature to its par value in 1 year, right? Therefore, here the rate of return is 5%, right? Now we're gonna show this 5% actually applies to any bonds here, right? The 2 year bond could be bought for 890, right? And then next year, the bond will have a remaining maturity of 1 year, and the 1 year interest rate is going to be 7.001%, right? This is already derived. This 890, it is 1,000 divided by 1 plus 6% to the power square, right? So this will already show. Right, so 6%, right? So that's why it's 890, right? Now let's look at next year. The bond will have remaining maturity 1 year, right? And the short rate for the future 1 year is 7%, right? So the price next year, right? The price next year, how is it determined? It is determined by the remaining cash flows, right? It's 1,000, right? Because at the end of the maturity, that'll be $1,000 divided by, again, this is all zero, right? So there's no coupon payment. So 1,000 divided by 1 plus the short rate. So the price will be 934, right? Now use this 934.49 divided by this this 800. Let me see. Yes, use this 934.49 minus this 890, right? You will get 5%. Right. So now you can see the 1 year holding period return will be 5%. Right. So this is kind of the idea. So after we talk about yield curve uncertainty, right? Now we're gonna explore the uncertainty here, which is we don't know how, we don't know what the future interest rate could be, and this is a more realistic case, right? In reality, we don't know the future interest rate, right? In that case, we need to introduce another kind of metric, which is called the forward rate, right? So the one sentence to talk about the difference between forward rate and the short rate is the forward rate is the expected short rate. Right? So short rate is the realized future interest rate, but forward rate, it is the expectation. Right? So you can see the forward rate here, we have this equation here, right? But how does this equation come from? So again, we have this equilibrium condition, which is so buying an n year zero should be equaling, I mean, the rate of return from, or the future value from buying a n year zero should be equal to buying an n minus year zero and then roll it over to another year, right? So now you can see this 1 minus yn to the power n, this is buying one n year zero, right? This is the component, so this is the future value of buying a n minus 1 year zero, right? And then this is the expected return you get from rolling over this n minus year zero for another year, right? So again, you can see this logic here is very similar to when we talk about yield curve uncertainty. But the only difference is that there, this future interest rate, this future short rate from year n minus 1 and year n is known, right? It is called a short rate. It is already known, right? Because we know that we are talking about the world where interest rates are known, right? But here they are not known. They are expected rates. Therefore, we call it 1 year forward rate for period n, right? So now you can see, again, this equation still it is coming from the competitive condition, competition condition, right? So or no arbitrage condition, which is all bonds offer the same rate of return. And it is, so that's why the forward rate, it is the break-even expected interest rate that equates the return on n year zero coupon bond to that of n minus 1 period zero coupon bond rolled over into a 1 year bond in year n, right? So this is what I just talked about, right? So this is the actual total return on the 2 n year strategy will be equal if the short interest rate in year n turns out to be equal to Fn, right? So what that means is that suppose the short rate is equal, is equal to the expected rate, then the actual total return on these two strategies will be equal. So this is what this is saying, right? That is, we have this expectation. Now expectation becomes true. So that's why these two strategies should be equal. Competition should drive those returns to the same. So this is one numerical example. You can take a look and calculate. So this slide tells you the difference between a short rate and a forward rate, right? So the short rate refers to a rate that is set either today or in the future. right? And then this is a realized rate. Right? And the forward rates always refer to a rate that is set today, right? So because it is set today, that's why for future, so that's why if the time period is in the future, this is gonna be expectation, right? So even though the time period alone may be sometime in the future, right? So what in the general rule, the forward rate in the first period, which is today, should be equal to the short rate today, right? Because this is just as of now, right? But in general, again, in theory, if the competition condition should hold, the forward rate, your expected short rate should be equal to the realized short rate. But in general, they are not equal, right? So it could be all different kind of factors that affect our realized short rate, right? But again, an easier way to think about forward rate, it is expected short rate. Right? I mean, I know it's not very strict because I mean, short rate is just by definition realized rate, right? But a kind of easy way to remember it is that forward rate is the expected short rate, but short rate is the realized future interest rate. That's the way to think about it. Again, we can apply the competition condition, right, in theory. So suppose the expected short rate is 6%, right? So we can derive the forward rate. Right? So we can derive the yielding maturity on a 2-year zero, right? So this is, if we use this 2-year strategy, that should be equal to the yield, the rate of return from the first 1-year strategy roll over to the second year, right? And then the expected short rate the second year is 6%. Right? Now, after we derive the yielding maturity, we can derive the price, right, which is this number. Now we have this interest rate uncertainty here, right? So now let's see where or when does this interest rate uncertainty matter here? When does this interest uncertainty matter here? Suppose the investor wants to invest for 1 year, right? And then they can do it in this way, right? Buy the 2-year zero today, and the expected return is 5%. Now again, we don't know about the future. And then next year, it will have 1 year to maturity, and the expected 1-year interest rate is 6%, right? So now next year, this implies the next year price is going to be 1,000 divided by 1.06. So again, it's a zero, right? And then the expected 1-year interest rate is 6%. So again, this expected 1-year interest rate is the expected 1-year interest rate for the second year, right? So therefore, the price at the end of the first year is this number, right? Now the holding period return, how do you get this? This is the price after a year minus the initial price, which is this number here. You get holding period return is 5%, right? Now, if you buy this 1-year bond zero and hold to maturity, you're gonna get a riskless return of 5%. Now, so what does this mean? This means the interest uncertainty, it is with the second year, right? First year, everything is fine, everything is certain, right? Now, the rate of return on the second year bond is risky, right? You can see if the next year interest rate turns out to be greater than 6%, then the bond price will be below this number, right? If this 6% is not 6%, it's higher, then denominator is higher, then the price will be lower, right? If R2 turns out to be less than 6%, the bond price will be higher, right? So now you can see, in order to incentivize, in order to encourage investors to hold these 2-year bonds, you need to offer a higher expected return, right? You need to encourage them to kind of hold this 2-year bonds, right? So that means this will imply that the 2-year bond need to be sold at a lower price than this price, right? So because this price, this is the riskless payoff, right? This is without any risk. But now you have risk about the second period interest rate, right? Because you only have expected interest rate. It's all expectation, right? But we don't know what is the realized interest rate in the second period. Therefore, in order to compensate investors for taking that kind of risk, we need to make sure the bond is cheaper, right? so that the rate of return can reflect this risk premium, right? Can reflect this kind of compensation for taking the risk. Now, suppose that most investors, they are short-term oriented, right? So therefore, they are only willing to hold the 2-year bond when the price goes down to this number here, right? So now at this price, we can calculate the holding period return, which is 7%, right? So now you can see the riskless return is 5% from the previous slides, right? So now you can see the risk premium here is 2%, right? And then this 2% is the compensation for investors to take the interest rate uncertainty into account, right? So this is basic idea. Let's look at one example. When bond prices reflect the risk and premium like we just talked about, right? So this F2 will no longer equals the expected short-term rate, expected short rate. Right? So then this I already talked about, right? So in general, the forward rate does not equal to the expected short rate because, I mean, there are all kinds of risks going all over the place, right? Suppose the expected short rate is 6%, the forward rate is 8%, right? So in that case, the yield to maturity is 6.49%. Right? And this forward rate is going to be 8%, right? So therefore, we can essentially solve this yield to maturity from this equation. Right, and then we get 8%. And then again, this 2% difference is the compensation for the risk, for the interest risk in the second period. Well, in general, investors do require a risk premium to hold a longer term bonds, right? And then this forward rate, it is the interest rate that would need to prevail in the second year to make sure that the long-term and the short-term investments, they are equally attractive, ignoring risk. So therefore, forward rate should reflect the risk premium. And we also call this risk premium liquidity premium because it compensates short-term investors for the uncertainty about the future prices. So why it's called liquidity premium? Because when short-term investors, they hold long-term bonds, they are essentially giving up the opportunity to invest in other short-term security, right? So therefore, their money is stuck in this long-term investment. Therefore, the liquidity is going down, right? So therefore, in order to be willing to sacrifice this liquidity, they need to be offered a higher return. That is the idea. And bonds, so in that case, bonds need to have prices that make forward rates greater than the expected short-term rates to reflect the liquidity premium. And this leads us to a series of term structure. And in general, there are two ways to look at term structure, right? So by the way, what is term structure? Term structure essentially is just the yield curve, right? So basically, it's a way to explain why the yield curve is the upward sloping, why the yield curve is downward sloping. So this is as simple as that. Right? Now, one theory to explain the term structure is that we don't take into account liquidity premium. There's no risk premium. So in that case, the observed long-term rate is going to be a function of today's short-term rates and expected future short-term rates, right? In that case, we implicitly assume that the forward rate equals the expected short rate, right? So in that case, risk premium is equal to 0. There are actually no risk premium, right? So in that case, the yield to maturity will be only determined by current and expected future one-period interest rates, right? So in that case, if there's no risk premium, then upward sloping yield curve will be clear evidence that investors anticipate increases in the future interest rates, right? So remember when we talk about yield curve under certainty, we talk about when the yield curve is upward sloping, there's no ambiguity that future interest rates are going to go up, right? So this is when yield curve is with certainty, right? And there's no liquidity premium. Right, so this example actually shows that, right? Suppose the 1-year interest rate is 5%, the 2-year rate is 7%, right? If you invest 100 for 1 year, then investment grows to 105. If you invest for 2 years, it could give you this one, right? So now the extra return that you earn for that second year is going to be 9%, right? Again, we are using the equation, the competitive condition for yield curve under certainty, right? Remember that equation to derive the second year return. Now you can see the second year return is greater than the first year, right? So this proves that investors' expectation of the future rates is going to be higher, right? So, and this example essentially shows you that, I mean, this expectation hypothesis is actually not very realistic, right? Because would you be happy to earn the extra 9% for investing for 2 years rather than one, right? Because if you are confident that this 9% is for sure, then of course you'll be go for it. But in reality, I mean, it's not, in general, it's not true, right? It's in general, the expected short rate will be different from this 9%. Sorry, the realized short rate will be very different from this expected short rate of 9%. The second way to explain the term structure is what we call the liquidity preference theory, right? So this incorporates the risk premium that we just talked about, right? In that case, the forward rate is greater than the expected short rate, and the difference is the liquidity premium, right? So now, if you have upward sloping yield curve, it could be because investors expect that the future interest rates are going to be higher. It can also be that this upward sloping yield curve reflects the risk premium of holding longer term investments. This is the idea. Right, so this liquidity premium can kind of confront our inferences about future interest rate, because if you have upward sloping yield curve, it could be that longer term bonds need liquidity premium to be held, right? Right, so that's why there could be confounding factors, right? It could be that the rates are going to be increasing. It can also be that investors require large liquidity premiums to hold long-term bonds, right? But in general, if you have a very steep yield curve, right, this can give you some comfort that in the future the rate's going to increase, right? I mean, because liquidity premium they are usually not very huge in normal times and do not tend to fluctuate substantially in all different times, right? So so if you have very steep yield curve, that tend to suggest that future rates are going to increase, right? Okay. Finally, we're going to talk about corporate bonds and the default risk, right? So because if you buy the bonds, that actually, I mean, whether the company pays you those coupon payments and the principal or not depends on whether the company are going to default or not, right? And you can see this graph so this table gives you the Johnson & Johnson's SP and S&P rating, right? So this is a credit rating, right? And other companies, right? Johnson & Johnson has a AAA credit rating, right? And the price of the bond is here, right? The yield is 2.16, right? Now you can see because Johnson & Johnson has a very high credit rating, you can see it doesn't have to offer a very high yield. Oh, sorry, it doesn't have to offer a very high coupon rate, right? And that's why it is reflected in the low yield on this bond, right? Only 2.16, right? Only when the credit rating is very low, like this company, right? Then the yield must be very high in order to attract investors. Right? Otherwise, nobody wants to buy the bond, right? Now, the yield spread of corporate bonds against US Treasury represent the overall healthiness of the credit market. And in general, this is a credit rating. So you have investment grade bonds, you have junk bonds, right? They differ by different credit rating. And the spreads between the corporate bonds and the US Treasury bonds represent overall healthiness, right? In financial crisis, these yields, they actually widened dramatically during the credit crunch in the 2007, 2009. And here we have listed different kind of factors that can affect the default risk, right? You can take a look. So this is another commonly used score called Altman Z score that reflects the default risk, right? If the score is lower than 1.23, that actually tells you the firm that they're vulnerable to bankruptcy. Otherwise, the firm is healthy. Right? So in general, these factors are quite intuitive, right? If the firm is profitable, has high asset turnover, has high working capital, they all reflect the fact that the firms are in good financial health, right? And in many cases, when bondholder, when the banks they sign a bond contracts, or investors buy bonds from the from from the firm, they will have a bond indenture, right? So we already talked about what is bond indenture. They are just bond contracts, right? And then in these bond contracts, there are different conditions, different provisions that help guarantee that the firm is going to pay back the loan or pay back the bonds, pay back the coupon payments in time. Right? For example, sinking funds, subordination of future debt, dividend restriction, or collateral. Right? So all of these are trying to guarantee that the firm is going to pay back the coupon rates on time. Right? And finally, the real rate and nominal interest rate. Right? So this, I guess you're already familiar with that, right? Because in general, interest rate, we have two kinds of interest rate, right? Real interest rate and nominal interest rate, right? So nominal interest rate takes into account inflation. And then there's a pattern between nominal interest rate and inflation. You can see this graph shows the 10-year nominal interest rate and 10-year real interest rate, right? The reason is that usually Federal Reserve or central bank, they have a target inflation rate, right, for period of time, right? So therefore, they need to target this inflation rate, right, by adjusting nominal interest rate, right? So therefore, you can see the gap between nominal interest rate and the real interest rate is in general stable because the target inflation rate between these two rates are in general stable. Right? And in general, the change in the expected inflation rate causes the same proportional change in the nominal interest rate. And it has no effect on the required real interest rate, right? And then this equation shows this equation is actually called the Fisher's equation, shows you the relation between the nominal interest rate and the real interest rate and inflation, right? Okay, this is so much for this week. And we're gonna do a revision soon. So in the revision week, I'm gonna go over the previous two classes.